Hello and welcome to this week's edition of the Retirement Compass, the show that helps you successfully navigate to and through your retirement. I'm your host, Kristen Oakley, and joining me in the studio today is Tim Kulhanek. He is the co-founder of Stonebridge Wealth Systems and partner Jeremy Gove. We've got a great and informative show for you today. This is actually the first of a two-part series. We are going to be unpacking the One Big Beautiful Bill Act, sharing with you the key updates of what you need to know about it and what it could potentially mean for you. Tim, Jeremy, I'm so glad we're going to tackle this because let's be honest, it's been a pretty confusing time since this bill was signed into law July 4th, 2025, has it not?
Absolutely has been, and the reality is we at Stonebridge, we want to be your go-to resource for these confusing tax topics, That's why we're really excited for today's show.
Yeah, for sure. And Jeremy, I know when folks are coming in to meet with you, they have no shortage of questions about what this means for them, right?
Right, and we're still waiting on some clarity on some of the, the IRS is still kind of identifying how they're going to, or what regulations they're putting in place to go along with the bill and kind of help us filter out the noise, I guess, if you want to think of it that way.
Yes.
So, yeah.
For sure. Well, we've got a lot of great information. We are doing a two-part series to break this down. I personally am going to be referencing my notes a lot because I want to make sure I get all this data accurately to you. And here's the deal. Over 1,100 pages in length is what this thing consisted of. And some of the provisions have already become effective. Some are going to be effective over a matter of years, and some are going to be retroactive to January 1st of 2025. So lots to get into here. But the first thing that's important to discuss is that prior to this bill being put into law, the 2017 Tax Cuts and Jobs Act rates were set to sunset at the end of 2025. So meaning tax rates were going to go back up at the beginning of 2026. Yep. Now that that is not happening, this is some key opportunity, a window of time where folks can really take advantage of it and engage in some strategic tax planning. If I can get my words out today, we'd be good. All right, so key updates here. What are some of the key provisions? And we're calling the One Big Beautiful Bill OB cubed, right? OB3, right. Just to kind of simplify. So from here on out, that's what we're going to refer to it. But what is the main thing regarding the extension of these tax rates? What do you want our viewers to understand about that?
Yeah, there's a lot of personal income tax provisions that I think we need to be aware of here. But I got a slide that we put together that there's really 12 main provisions that I think people need to be aware of. But on this two-part mini-series, what we're going to focus on is specifically what I think are the key 6, if you will. So those are highlighted now. Okay. That's what we're going to be spending most of our time on.
Okay, so the ones that are in the white outline there,
That's
right?
Correct.
That's what we're going to be focusing on. Okay, so where would you like to start?
So here's where we're going to start. Let's look at the one that gets the most press and headline, and that is the permanence of tax brackets. So there's a lot to unpack with this because it isn't as straightforward as one might think. First thing I want to note is permanent in Washington means until somebody else comes along and changes it,
I was
right?
saying until they change their minds, right?
There's an old saying that everything in Washington is written in pencil. Second is the bracket themselves will actually change next year. However, it is the rates that have been designated as permanent. So in other words, had this change not been effective, and I think I said that backwards on the screen, it's the dark blue ones that we're going to focus on, not the ones with the white outline. But
there we go. Yes.
Anyways, the thing is, had this rate not been effective, somebody in the 12% bracket would have seen a rise to 15%, 22 would have gone to 25%, and 24 would have gone to 28%. So we're talking about a meaningful tax increase that everyone would have realized had they not made these rates quote unquote permanent. So that's the first thing I want to remind folks. The second thing is we actually have a slide that we put together as well to show you just what those brackets are. So that way we can kind of refresh the memory. It's 10, 12, 22, so on and so forth. Now, most people that we deal with, because the majority of Americans, middle income earners in America are paying at 22%. We get people on all ends of the spectrum. Here, there's just not that many people across the country that pay at 37%. That's like probably top 1% of income earners. But this is where rates are at right now, and for the foreseeable future, because they will have to change the tax law now to get them to rise. It won't just happen automatically through a sunset.
And just to clarify, these are for married filing jointly.
Thank you.
Correct?
Yes.
Okay, I just want to make sure our viewers
married
are
filing jointly. Look, we've got all the rates for single or head of household.
Yep.
This gives you, I was more focusing on the rates themselves.
Correct.
Whether you're single or married filing jointly, these are the brackets that you will navigate through.
Yes.
Yep.
Okay, cool. So I know we had another graphic from a previous show that you wanted to bring back up that really can help illustrate the power of what could have happened to tax rates and brackets had this Tax Cuts and Jobs Act expired. Do you want to walk us through this?
Yeah. So we have a slide we called it graduated cylinders. If you guys, So you can see right there. So on the left-hand side, you have 2017. That's where where everything was at. So all the different brackets, and you can. We built that slide just to kind of help understand. It's a progressive system. So you start out at 10%, then you go up to 15, 25, 28, 33, 38, 35, and then 39.6. I can't quite read it over there.
39.6. Yep.
And so the point of that is you're not paying if you made $400,000, you don't pay 39.6 on all $400,000, right?
Right.
So that was in 2017, and that's what if this didn't get extended, the Tax Cuts and Jobs Act would have, as Tim mentioned, it would have sunset. So then we would have reverted back to that. So now if you look at the TCJA, the 2024, right there, you can see if you're in that 24%, if you hit that 24% number, that's a lot broader.
Well, you have more income before it gets taxed at a higher rate.
Yeah, so
right?
you start out, you're still starting out at 10%, but the 22 and 24%, that picks up the majority of America, I think is kind of what I guess the point of that is.
Right, whereas the previous, code, at that same level of income, they were already being taxed at the 33, 35%.
Exactly. It was like about $100,000 reduction if we would have gone back to this at the 24% bracket of additional income that you can have and stay in the 24% bracket because these were made permanent. That's a huge deal.
Right. Yep. Now, why is this such a time-sensitive huge deal? Like, what actions are you encouraging your clients to take as a result of what has been passed with the One Big Beautiful Bill?
Well, so we, previous to that, we were talking a lot about Roth conversions. We have to get Roth conversions started just because we thought this was all going to sunset.
Right.
But the nice thing about this is beginning in 2026, there is an extra year of inflation adjustment. So the 10 to 12% brackets, they'll actually receive that through 2025. The broader, that means that more taxpayers will actually remain in those brackets rather than jumping into the 22% bracket.
Right.
Sorry, we have to read a lot of our notes as well.
No, for sure, because like I said, it has been very confusing.
We wanted to get it out to
Yes.
everybody, but it's very confusing. So.
Yeah. Well, and I love that you are staying on top of this because, again, and correct me if I'm wrong, what this is doing is extending the window of opportunity to systematically engage in Roth conversions rather than, we got to hurry up and get this done before 2026. Well, now we know we have at least 4 more years, essentially 3 more years to be able to play with those brackets as they are.
I mean, if we use history as a guide, probably a little bit more than that, just because if you go back and look at when there was a tax decrease, historically speaking, how long did it take before there was a corresponding tax increase by a subsequent legislation? Somewhere like 8 to 12 years.
Right.
So we'd like to think that we've got a little bit of time, a window of opportunity here. But the thing that Jeremy was talking about, this is why I think it's so important to make sure that you have somebody who understands this terrain, who can help you navigate. There's a minefield, tax minefield, standing between you and a tax-efficient retirement. That's just the reality. And this bill didn't make it better. Now, it gave us some great benefits. It might have made our tax situation better, but it didn't make the understanding of the tax code better. It took, I think, the Senate clerks 15 hours to read all of these pages, 15 to 16 hours to read all these pages of the One Big Beautiful Bill Act, because that was required before they could pass it. And the question is, how are you going to understand all of that? How are you supposed to dissect these 1,100 pages? And the way I see it, folks, sitting at home, you've got 3 options. One is you can just ignore it and say, you know what, whatever happens, happens. And that's certainly a choice you can make. Number 2 is you can dig into it. You can read the bill. You can spend your time surfing the web to try to find out what exactly this means for your unique financial situation. But there is a third option. And that third option is sitting right in front of you right now on the TV screen. It's calling that number and visiting with one of our experienced advisors. It's not just the team at Stonebridge. We are backed by a wealth of knowledge, be it the Ed Slott Elite IRA Advisor Group. There's a lot of different teammates that we have that you don't see on this show that can help break down and help you understand exactly what this bill means for you and use it to your advantage. I encourage you to get started today.
Yes, for sure. And because you stay on top of this, I know that folks are going to be relieved to know, okay, they have expertise that they can come and consult to figure out literally what these changes mean for them. So Tim, Jeremy, thank you so much. If this is something that you've been needing help with, if you want to find out how you can take advantage of the current tax code for yourself, we encourage you to reach out and schedule your complimentary written financial review today. You can do so either by calling 866-256-7778, or if you'd rather connect online, simply scan that QR code and that will get you connected as well. Stay with us. We've got a lot more to share with you regarding updates that impact you as a result of the One Big Beautiful Bill right after this.
Have you ever taken your family out to dinner and been shocked at how expensive the tax bill was? Well, guess what? Right now in the United States, there are around $37 trillion in tax-qualified retirement accounts like pensions, 401ks, and IRAs, and the vast majority of those dollars have never been taxed. Hi, I'm Tim Kulhanek, co-founder and financial advisor at Stonebridge Wealth Systems, and I want to take a moment to have you think about how much money you've saved in tax-deferred retirement accounts. Did you know that not all of that money is yours? That's right. When you put money into an IRA or a 401k, that is like going into a partnership with the IRS. At Stonebridge Wealth Systems, we have created a free online tax calculator to show you what you could pay in future taxes on your retirement accounts. Go to stonebridgetaxbill.com or scan the QR code below. That's stonebridgetaxbill.com.
Did you know your retirement savings isn't entirely yours? That's right. Your traditional 401k, IRA, or pension is actually shared with the IRS. And when it's time to withdraw, they'll be waiting for their cut in taxes. To find out how much you could owe, try our easy-to-use tax calculator. Just scan the QR code or visit stonebridgetaxbill.com.
Well, welcome back to the Retirement Compass. I'm Kristen Oakley here with both Tim and Jeremy from Stonebridge Wealth Systems, and we are so glad that you're joining us today. If you're just tuning in, today's conversation is a part one of a very important update regarding some of the critical changes that have come with the One Big Beautiful Bill, and specifically what that could mean for those of you who are nearing or already in retirement. So next up, and again, we're referencing our notes because there's a lot to know here. There's a lot to get right. We want to make sure we don't miss anything for you. The second key change on your list has to do with the changes to the standard deduction. So Jeremy, can you tell us more about that?
Yeah, so the standard deduction as it stands right now is $30,000 if you're married filing joint. It's about half that, but it is half that if you're a single filer. And so that doesn't change for 2025 because it actually is getting it's reset at January 2025. So that part didn't change, but going forward, the standard deduction when it gets a 5% increase, and so for if you're married filing, actually I'm sorry, that does actually start in 2025.
Yeah.
Mm-hmm.
They increased it a 5% increase, so it's actually $31,500 if you're married filing joint right now for this year.
Mm-hmm.
And if you're a single filer, you also get the same 5% bump, so it's actually $15,750.
So really what that means is that the majority of taxpayers should be seeing some amount of tax savings even beginning in 2025.
Yeah,
correct?
immediately. Yeah, from where we thought it was at $30,000, now it's $31,500.
Right. Okay.
Yes.
And this applies to all filing statuses. That's the other thing that we want to clarify?
Yeah, that's correct. So basically vast majority of U.S. taxpayers are going to fall into that, married filing joint, or you're going to either be single or I guess married filing joint. So
Yeah.
It would be everybody.
Yep, everybody's getting it. And, the one thing that I noticed is this would have been, I was checking my notes from earlier, it would have been about a 12% drop in deduction. So like if you really, I can't overemphasize how significant this was, Kristen. Mm-hmm. We would have not only seen a increase in tax rates, a shrinking of the brackets, but a reduction in the deductions, the standard deduction, because we could on back to the old system where you had personal exemptions and a smaller standard deduction. It would have been significant. And again, one of the tools we have in our office will show you just how significant it would have been. We could compare pre-TCJA, so before the 2017 rules, We can show you the TCJA rules, and now this change with the One Big Beautiful Bill Act to show you, are you going to pay more or less in taxes?
And so again, what's the biggest takeaway that you want? I know this segment's going to be a little bit shorter, but focusing on the fact that, okay, the deductions have changed, right? All this, what does this mean? What does this mean for those who are nearing retirement or who are already in retirement?
Yeah, I think I go back to the tools that we have that can help you understand your finances in a way that you've never seen them before. Because the reality is, if you think about a 1040, how much fun is looking at a tax return? Nothing against our CPA friends and enrolled agent friends out there.
You have to love it, right?
You really gotta love it. You really gotta love it. And to the average consumer, it's like, whatever. That's why I have a CPA. That's why I have a tax preparer. That's why I have TurboTax. I just punch in the numbers and it gives me the result. But the reality is there's a lot more to tax planning than that. And we like to keep it simple. We like to make it so it's understandable and something that you can wrap your arms around. So we use a tool, we call it Tax Clarity. It's called Tax Clarity from our friends over at Kavisam, which are just down the road in Omaha. We actually have an office in Omaha. And it's this amazing tool that essentially, remember back in like 1997 when you went Christmas shopping and you walked into the mall, let's say we're going into Gateway Mall or the Hilltop Mall, and there's a kiosk-like little thing there. It looks like a big map. And it's a map, in fact, of the mall and all the stores.
And it says, you are here,
It
right?
says you are here, and a red dot is placed right there.
Yep.
We're going to give you a way to see your taxes in a different view that's literally going to put you on a tax map. And it'll give you the red dot. It'll say, hey, you are here. And all of a sudden, you can visualize the different opportunities that could come about from doing what I call advanced tax planning. That could be things like Roth conversions. What if I sold this stock? What if I realized a gain? Will I stay in the 12% bracket, which means that effectively I'd pay zero in capital gains? What's the impact if I sell a property? There's so many things that we can do with this very flexible tool. But if you spend too much time focused just on one aspect of your plan, so some people just obsess over their returns and they want to build their nest egg. They don't realize that while they're out trying to grow this nest egg and focusing just on the stock market, there's a fox that's getting into the hen house. And by the time you go and open up your carton and you're ready for retirement, all the eggs are crushed because you weren't paying attention to somebody getting under the wire. In this case, unnecessary taxes because it wasn't a key focus of your plan like it should have been. At Stonebridge, we make sure that you have a holistic plan that focuses on all 5 key areas of planning: income, investment, tax, healthcare, and legacy, because we think you deserve that. Now, if you're ready to take action in making sure that you do have a comprehensive plan, that'd be a reason to get your complimentary written financial review by calling the number on the bottom of your screen right now, and we look forward to seeing you in our offices very soon.
Wonderful. Tim, Jeremy, thank you so much. We encourage you to reach out so you can start this process today of receiving your very own comprehensive holistic financial plan, figuring out what all these updates mean for you. And it starts with you picking up the phone and calling the number on the bottom of your screen to receive your very own complimentary written financial review. 866-256-7778 is the number to call. Or again, you're welcome to scan that QR code and that will get you connected as well. When we come back, what about taxation on Social Security? We're going to dive into that and what the OB3 has done from that standpoint when we come back.
There's no shortage of opinions about annuities. Some people love them, others hate them. But here's what matters. The right annuity in the right situation can solve very specific retirement challenges. Whether it's guaranteed income, market protection, or legacy planning, different annuities are built to serve different purposes. The problem is, too many people own annuities that no longer match their goals, or worse, they never did. Some have high fees, others come with outdated features, and too often, people buy them without understanding what they're getting. If you've been holding on to an annuity for years, or if you're not sure exactly what you have or how it works, now is the time to take a second look. Our complimentary annuity review can help you understand what you own, what it's doing for you, and whether something better is available in today's market. Refinance your annuity today and make sure it's working for you, not against you.
Do you own an annuity? Are you aware of what type of annuity you own? For years, annuities have been a cornerstone of retirement planning. But they're not all created equal, and your current annuity might not be serving your retirement goals. The good news is, rising interest rates could mean better guarantees and better benefits for your annuity. If your annuity is not working for you, wouldn't you like to know sooner than later? Call now for your complimentary annuity review.
I wanted to take a quick minute to talk about something we don't often bring up in financial conversations, but probably should. Estate planning. Not just the legal paperwork, but the clarity your family might need if something unexpected happened. Here's the truth. Most families have some of their planning done, but not all. And often the hard part isn't the money, it's the confusion, the decisions, and the pressure that falls on people left behind. That's why we created something to help. It's called the Legacy Quiz. And in just a few minutes, it can give you a sense of where you stand, what areas might need attention. It's quick, it's easy, and you can take it right now at stonebridgelegacy.net. Let's help make sure your plan isn't just in place, it's actually usable when it matters most.
Welcome back to the Retirement Compass, where today we have been unpacking several of the key critical updates that have come about as a result of the One Big Beautiful Bill. And one of the issues that has received the most attention, I know in the media, so many folks have been talking about it, is taxation on Social Security. So we need to explain this because did it go away? Is it still there? What the heck is happening from that standpoint?
Yeah, one of the most confusing aspects of this bill, and I'm just going to give the short answer, no, it didn't go away. They would have needed a supermajority to change the way that Social Security is actually taxed. This was passed through reconciliation, so they only needed 50 votes in the Senate. So Social Security taxation, the provisional income, all those different formulas that we've talked about on past shows that we're happy to share with our the viewers once they give us a call or come into one of our offices, will explain how your Social Security gets taxed, but no, it's still subject to that.
Mm-hmm. And this is one of the things I think has been really disappointing, because I think a lot of folks, myself included, was very excited about the thought of taxation going away on Social Security. Yeah. But you mentioned phase outs. So explain how this additional deduction is helping some folks.
So what they did is they added an additional $6,000 per person age 65 plus. So for a married couple filing jointly, that's $12,000 of additional deduction. And then they did the math, essentially said, hey, this is going to wipe out taxation on Social Security for a large portion of the American public. There's all kind of cascading impacts on this. I mean, in a future show, hopefully we can get into the fact that this is now going to accelerate the depletion of the Social Security Trust Fund, because one of the ways Social Security is funded is through income tax that's paid on Social Security benefits that are received. Mm-hmm. So don't be surprised if you see it go from like 2033 to 2032. But I think I've got an example. Hopefully we've got a slide that we can pull up here, giving you an example of what could happen. So this is that phase-out example. Thank you. They're both 65 plus, and let's just assume modified adjusted gross income, which just use your adjusted gross income, and we can help you with the modified part, is $150,000. They want to convert money to a Roth. They're like, Tim, I want to do Roth conversions. I heard you on the show. You said to do Roth conversions. That's not specific advice. Mileage may vary. You need to come in and visit with one of our experienced advisors before you would implement any of these strategies you hear on the show. So they're going to convert $100,000 from traditional to Roth IRA. Well, here's what actually happens. I think we can go to the next slide if we have it. But what happens is Joe's going to pay income tax. This is Joe and Cindy, by the way, on that $100,000. And so you can see that's taxed at 22%. That's $22,000 in federal taxes. But unfortunately, he's now, that $150 is the beginning of the phase out for married filing jointly. So he's now going to phase out of $12,000 additional on $100,000. He's fully phased out. It's between $150,000 and $250,000. So he's going to fully phase out of that $12,000. So now another $12,000 is taxed at 22%, which is $2,640 of additional tax. So even though intuitively Joe and Cindy thought they were going to pay 22% on their conversion, not so fast, my friend, a reference to our great Lee Corso example, they're actually going to pay 24.64%. So for most people now, they're 65 plus, the 22% bracket essentially doesn't exist because they'll hit these phase outs.
And this is what's scary, right? This is it's important for folks to understand and work with experts to navigate through that, because there's so many tax landmines, if you will. And I know we're going to do a part 2 to continue this conversation next week. We could easily do a part 3 and part 4 because it is really confusing, right, Jeremy?
Yeah, absolutely. So the phase outs, and we'll talk more about this a little bit, but your adjusted gross income is it's half your Social Security benefit plus, or I'm sorry, your provisional income, and how they tax Social Security and figure out how much of your Social Security is going to be taxable. It's the provisional income. It's basically half of your Social Security benefit, so as a household, plus any other income that you have.
Right.
Okay, so that's really what's going on. The problem is where that gets tricky is you could end up in a 55.94% tax, or that would be your effective marginal rate if you do Roth conversions and some of the examples, as the example that we just gave.
Right.
So
55.94%.
yeah, if you're just working, what's the highest tax rate? You know, for us right now, well, we're still working, it's 37%.
Yeah.
So
Right.
it's a big potential problem if you don't do a lot of planning and get it right.
Clearly. Well, and here's what's so frustrating about taxation on Social Security. They factor in that equation for your provisional income, how much you're receiving from Social Security in order to determine how much they're going to tax your Social Security. I mean, this is the insanity of it, right?
It's a little circular,
yeah. And so I know folks are wanting help with this. Gosh, I know we've covered a lot. We really hope we haven't confused you. This is why you guys specialize in this stuff. You stay on the forefront, making sure that the folks that you work with know what's happening, know what these changes are, and most importantly, know what it means for them. So what would you like to leave our viewers with as we wrap up this part one of the OB3 discussion?
I would just encourage them to imagine their retirement as a journey, because it truly is, right? But imagine it as an open ocean journey, okay? And you're going across the Atlantic, you're going to Barcelona, wherever you might be going. The reality is, like, when you're on the open ocean, it's really not that many hazards or different things that you have to contend with. You're probably at the pool, you know, you're having a good time, you're drinking mimosas, everything's good. But this journey has taken, you know, sacrifice, scrimping and saving and doing without. And what started as this, I think we've got a graphic to show you, started as this, has now become this. And as you approach retirement, what you need to do is call a harbor pilot. This is a real world example. If you have a ship over a certain size, once you get close to the harbor, you'll see a little boat. If you've been on a cruise, a little boat comes aboard or comes up next to the ship, and a captain who is a harbor captain pilot comes aboard, because they're an expert in navigating all of the cables and currents and cross tides and ship traffic coming in and out of that port. At Stonebridge, we are harbor captain pilots. We are designed specifically to help you through this final part of the journey to get you home safely. We're excited to do it for you. Give us a call today and we'll start.
Wonderful. Tim, Jeremy, thank you so much. 866-256-7778 is the number to call to start that journey for yourself today. Thanks so much for watching. We'll see you next time here on the Retirement Compass.